So transfer pricing. In transfer pricing, within the same organization, we assume two departments. The finished goods of department A may be the raw material for the department B. Is that okay? So A department gets the material, converts that into the finished goods and may sell it to the outside. Or it may be transferred to B. Similarly, B can get his finished goods from outside, raw material, and manufactures and sells outside. For example, the goods sold outside by A being 10 rupees, if the same goods is purchased by department B from outside, maybe 12 rupees. So then the common head, the organization head can recommend, rather than making B buy from outside, it can now buy from A. So naturally what happens, B will get 2 rupees cheaper. 2 rupees cheaper. Even sometimes A can sell it to the outside at rupees 10. B can also purchase the same from outside at 10. But while selling, from here to the customer hand, he has to incur some expenses. Okay, carriage out and all, commission. So net to realizable value being only 9.5. For B, while purchasing it from outside, he has to pay some carriage in other expenses. So automatically it's 10.5. Rather than selling the goods by A to outside and buying it from B, buying from outside for B, logically there is a loss. So then organization common head will recommend to transfer between A and B. Even sometimes still different thing may happen. Okay. The price saleable in the market at rupees 10 and B also can buy it from outside at 10. And by buying it for 10, B makes a loss. A makes decent profit. Okay, so what happens here? Buys it for 10 and incurs another 5 rupees expenses. 15 rupees is the cost of goods manufactured. Sells it for 14 and 1 rupee being the loss. And for A, it's quite a bit profitable only. Buys the material for 5, converts it by adding his own expenses too, and sells it for 10. Naturally, there's a gain of rupees 3. The in charge of department A may be happy. He may get the appreciation as well as incentive and all, but B department's head will feel uncomfortable as he consistently faces loss. And A says, I will sell it for 10 only, as I'm able to sell it for 10 outside. I demand the same price while transferring from my department to B department. In that case, common organization head will say, don't sell it to outside. You sell it for 8 rupees 50 paise. By doing that, A 7 rupees is the manufacturing cost, 8 rupees 50 paise is the transfer price on 1 rupee 50 paise gain for A. And for B, purchase of material being 8.5, another 5 rupees is expenses incurred for converting the raw material to the finished goods, 13.5, but sale price is 14, so 0.5 gain. Such a way the organization head may fix a common price so that A will also making a profit like and B also making a profit like, because by fixing the transfer price being 10, which is normally tradable in the market, B will be facing loss only. That department will be getting demotivated, and while analyzing whether we can shut down any of the divisions, we may go for shutting down the division B. Sometimes later division B may again get picked up in the market and huge return may be expected. Why do I want to close this department now? So these are the cases we have, and the common organization head will come for the fixing the transfer price. And the transfer price may happen within India, or one division may be in India, another division outside India. So then the transfer price may be fixed, will be called as international transfer price. Domestic as well as international we have. In taxation, you have a separate chapter regarding this transfer price fixation at final level, especially taxation. manipulation of the profit may be possible. Okay, so by fixing the higher sale price, you can increase the profit. By fixing the lower price, you can reduce the profit. Such a way, you can manipulate the profit earned by you. So, in order to avoid that, the government will always comes for questioning you to fix the transfer price properly. But for the management accounting purpose, we need to fix the transfer price in such a way all the divisions should make better out of this by fixing this price, and overall organization revenue will be increasing. That's the intention here. Sometimes, we have the two divisions A and B. A and B. Okay. A can manufacture and sell it to the outside at rupees 10. B can purchase it from C. Okay, for rupees 12. From this, it is very clear. Logically, it is not advisable to purchase the same material from C at rupees 12, where this may be the common material, may be transferred to B as a raw material. This could be either transferable or he can sell it to outside, but A is now selling currently to outside. But if he sells to B, B can get the material for 10 rather than 12. Definitely 2 rupees profit will be increased for department B, yes or no? But there is one more division called C. Division C. Not connected with the department A and B, but this C department manufactures and sells the goods to C. Because of that, the profit alone rupees 4. Profit alone rupees 4. Is that clear? By selling the product manufactured by the division C to C, okay, this is customer. This is customer. This is division C. Division C manufactures and sells it to the third party. Because of that, he can make a profit of rupees 4 per unit. Right. Now, A can sell it to outside at 10. B can also gets it transferred from A for 10, but he actually currently purchases it from outside for rupees 12. So naturally, what is profitable? Transferring the finished goods of A to B, where it is going to be used as a raw material, at the rate, same value at which it is sold in the market, say rupees 10. Logically, that may be correct one. Logically, that may be correct one. Is that clear? Now, the common head says, okay, logically correct. By doing this, A can fix at 11 rupees, right? Okay, if he fixes 11 rupees, he will get 1 rupee excess. B will also get 1 rupees profit excess. Even the price at which it is sold to outside, if it is sold for the same rate to B, B will get 2 rupees profit, no profit for A. Is that okay? No additional profit. But common head says, don't sell it to B, sell it outside, because this purchase from this customer rupees 12 interlinked with the sales of another department to this customer. If you stop purchasing it from the customer, immediately he will say, I don't purchase it from C. If he says so, that we will be ultimately losing 4 rupees profit because of saving rupees 2. The ultimate return will be lost too. Okay, so every division should make good profit. Every division should make good profit. That's good. That's what about the goal of every division? Every division. Is that clear? Don't forget what? Because of making that the goal of making good profit for every division should not affect the organization's common goal, organization's common profit. See, A says I am selling it to outside for 10. B says I am purchasing the same from outside for 12. Rather than purchasing it from outside for 12, I can sell it to or transfer this to you at the rate of rupees 10. So you can save 2 rupees profit, or you can share 1 rupee and I can take 1 rupee. This will be the profit for division A and B. But the organization is always comprises n number of different departments, A, B and C also. If B does so, then C will not be able to sell it to the customer making 4 rupees profit. So 4 rupees loss will be there, profit is forgone, and 2 rupees saved here. Ultimately, you are losing 2 rupees. Always the common head thinks over What about the overall profit of the organization, whether it is affected or not due to the divisional head's decision? So always the common head will think over divisional heads decision regarding the goal, their own goal, should not affect the common goal of the organization. This is called goal congruence. Goal congruence. Transfer price is nothing but fixing transfer pricing for divisional transfer, maybe domestic or international. Right. Anyhow, for the management accounting purpose, we never bother about the taxation aspects. Here we'll be bothering about can we fix a different price for the transfer purpose to make best out of it for the management. Goal congruence. The decision made by each division are in the best interest of the entire organization. A's this goal and B's goal. Regarding that, if they take any decision, it should not affect the entire organization's goal, rather than solely optimizing the performance of the individual division. So you should not optimize the profit of individual division alone. Try to optimize the individual division's optimum profit, but along with what? Overall organization's interest should not get affected. It's called goal congruence. Is that clear? How the transfer pricings are fixed? So cost based transfer, market, negotiated price, all these things are we have. Anyhow, we'll start with an illustration. Then and there I explain what model they have followed so that you'll be able to understand this easily. Now, question number one. Find the transfer price to be fixed under marginal cost method, absorption cost method, standard cost method. SSA Limited has two processes. SSA Limited has two processes, preparing one process, finishing another process. Okay, this will be SSA Limited. The normal output per week is 7,500 at 75% capacity. Okay, so currently they are producing 7,500 units produced, which is 75% capacity only. Then they have the spare capacity to produce another 2,500. By producing the additional units, of course, you are incurring only variable cost, fixed cost will not be incurred. Is that okay? SSA Limited has production problems in preparing process and required 2,000 units per week of prepared material for the finishing department. So this department requires 2,000 units further to be supplied. Their 100% capacity being 10,000. 75% capacity is 7,500 means 100% capacity should be 10,000. The existing cost structure of one prepared unit of preparing process SBB Limited at the existing capacity is as follows. Okay, variable cost and fixed cost. Material 2 rupees purely variable. Labor 2 rupees purely variable only to 50%. Another 1 rupee will be fixed cost. Manufacturing overhead 4 rupees, variable being 25%, fixed being 3 rupees. So variable cost per unit being 4 and fixed cost rupees 4 rupees. Any of fixed cost 4 rupees will be applicable for the current scenario, current capacity. Okay. Now, this is the production per week. The sale price of completed units of finishing process is 16 with a profit of rupees 4 per unit. The sale price. From here, the goods are sold for rupees 16. Okay. Finishing process 16 with a profit of 4 rupees per unit. Calculate the effect of profits of Transferor Limited for 6 months, 25 weeks. This is all about per week basis. For 25 weeks, yeah, how many units are in need? Here 50,000. Is it? 7,500 currently operated means for 25 weeks 1,87,500 can be manufactured, and spare capacity being another 50,000. How many? What's the spare capacity they have? 10,000 only. 7,500 is produced. 2,500 is the spare capacity. Otherwise, 25%. Do the cross multiplication. What is the spare capacity? 62,500, and full capacity should be 2,50,000 is the full capacity. Right. Now, what transfer price can be fixed? Transfer price can be fixed based on these ideas. Okay. Variable cost per unit being 4 rupees. Fixed cost per unit for the current capacity being 4 rupees. And sale price of finishing process is 16, includes profit rupees 4 per unit. 4 per unit. Now let's try to finish up this. Yeah. Now fix the transfer pricing based on what? Marginal cost only. Already they are operating 75% capacity and selling the goods to outside, making a decent profit. Now they have only spare capacity. So finishing department may request, as you have the spare capacity, produce and give me the additional cost you spend for producing 2,000 units. The additional cost you spend for producing 2,000 units being only the variable cost. Fix that as a transfer price. Fix the whole price for the outside. Never bother about fixing the transfer pricing to the others. Okay. So then what could be the price here? 4 rupees per unit. 4 rupees. What could be the increase in profit? So what is the increase in profit? Increase in profit being 0. Isn't it? For producing one additional unit, they spend around 4 rupees. Price is also fixed at 4 rupees. You don't get any profit, but all the profit is now transferred to the other department. Definitely P will not accept. The department head, P department head will not accept. Sir, how sir? We are working. No, give some benefit to me. Okay. Whatever the marginal cost you spend on that, 25% can be addable. 5 rupees, sir. Can we fix the transfer price at 5? Yeah, of course you can fix. By fixing at 5, increase in profit being how much? 1 rupee per unit. Yes, the overall 50,000 units will get a profit of rupees 50,000. Is that clear? And third one, marginal cost plus 15% on return on capital employed. So the preparing department says, sir, marginal cost okay, but of course I am doing additionally by spending 4 rupees. 4 rupees is okay for manufacturing one unit, but need to get some benefit. No, we have invested the amount in the capital assets, plant and machinery. Okay, leave about that. So for the depreciation of this, you give some return. So what happens here? Assume capital employed being 20 lakhs. This fellow expects 15% return. So 20 lakhs, 15% return, of course. This is all about for half year. You have to find out for half year. How much extra money he demands? 1,50,000 rupees. What is the number of units he transfers? 50,000 rupees. 50,000 units. So he demands 3 rupees extra. 4 plus 3, 7 rupees. Increase in profit being how much? Okay, this 1,50,000. Increase in profit is equivalent to 1,50,000. Hope you will be now able to understand. Either you can fix the transfer pricing will be just a marginal cost, or with the marginal cost small margin is added, or marginal cost plus based on some other factor he may calculate some additional return expected by the transferor. Fourth being absorption costing. What is called absorption costing, sir? Absorption costing is nothing but total cost of goods manufactured, traditional costing. direct material, direct labor, direct expenses, all these things are prime cost, and add the fixed overheads and all. So then the value being 8 rupees. 8 rupees. Is that okay? But of course, 4 rupees is the additional cost you spend for manufacturing, but you fix at rupees 8. 4 rupees will be your profit per unit. So increase in profit per unit being 4, or total being 2 lakhs. For 50,000 units, it should be 2 lakhs. Per unit, it is 4. For 50,000 units, we will be getting a decent profit of 2 lakhs. And fifth one, existing cost plus a portion of profit on the base of preparing cost divided by total cost into unit profit. Existing cost is what? 8 rupees. Existing cost is 8. A portion of profit is going to be addable. How do we calculate this? Whatever the profit we get, 16 rupees is the selling price, 12 rupees is the profit included, and so 4 rupees and 12 rupees is the total cost for manufacturing that. So from the profit 4, a portion of profit, which portion? Preparing cost divided by total cost. Preparing cost divided by total cost. Now, what about the preparing cost? Preparing cost is 4 plus 4, 8. What is the total cost for finishing department to sell it outside? 16 rupees is the sale price, and profit for F is 4, then definitely 12 is the total cost. 8 is the cost for preparing department, and for finishing department, the total cost being 12 rupees currently. 12 rupees is currently. And the decent profit made by finishing department is 4. In that 4, 8 by 12 proportion will be addable with the sale price. Now come on, find out the transfer price here.
10.67.
Preparing cost divided by total cost, right? How much? 10.67. Now you know that 4 is the marginal cost, 6.67 is increase in profit per unit. Per unit. And for 50,000 units, multiply with 50 to find out the ultimate value. 3,33,500. Hope you will be now able to understand this one. The last variant being, forget about all these things, sir. We'll fix 8 rupees 50 paise, which is a market price. I sell it for 8 rupees 50 paise in the market, and we'll fix the same. In this case, 8 rupees 50 paise is the transfer price. Marginal cost will be 4 rupees. Then incremental profit being 4.5 per unit. For the total supply of 50,000 units, what could be the total increased profit? 2,25,000. Hope now you'll be able to understand the fixation of transfer pricing under different model. Different model. See, methods of transfer pricing. Cost based transfer pricing. Whatever the cost incurred for manufacturing will be the base for fixing. Marginal cost, absorption cost, standard cost. Even we have the two-part tariff. We'll see that later. Two-part tariff is nothing but marginal cost plus some extra fee will be addable. Extra fee will be addable. Similar illustration, we'll see that later on. If market price is unavailable, the transferring division is treated as cost center. Okay, cost center means all the cost is pooled for that department, and based on that, the cost for per unit is identified. The same cost is expected as the transfer price by adding some extra for their commitment, like profit or any fee. Like sometimes we may use the market price and negotiated price and all, right? So hope you'll be now able to understand this one. If you are clear with question number 1, let me know so that we move on to the next illustration. Now we'll move on to the next one. We'll now discuss dual rate transfer price method and two-part methods additionally. SBB Limited has two divisions, Division A and Division B. Division A produces a unit with a marginal cost of ₹10. For Division A, marginal cost being 10, market selling price being 15, sold at ₹15 outside. For the customer, it is sold at ₹15. Division B manufactures a product that requires one unit from Division A with a marginal cost of ₹6 and a market selling price 20. So, Division B can also manufacture using the material manufactured by A as a raw material. So, transfer price paid to A, with that they add additional marginal cost ₹6 and the final sale price in this case being 20. Now the question is transfer price. If the transfer price being 15 as the transfer price fixed by A while selling to outside, your overall cost is 21, selling for 20 is loss only. Seems to be non-motivating factor for the Division B. That's a scenario. Now the question is all about what could be the decent transfer price so that these two departments will be happy. Without considering any other factors, is manufacturing the product advantageous for SBB Limited? SBB Limited. Would implementing a transfer pricing system based on market price incentivize the manager of Division B to produce the product? Currently, if the same 15 rupees is fixed for him also, naturally what happens? There will be loss ₹1. Lost ₹1. Is that clear? Definitely department B or head of B will not be happy. Is that clear? Now, in order to avoid this, we now introduce dual rate transfer prices. What is called dual rate? A is not happy to sell less than 15. Why? A says I can sell it to outside at ₹50. B will be unhappy for payment of 15 rupees. Is that okay? Then what happens here? Very simple. Now the transfer pricing will be reasonably lesser to make B department head also happy. B department head also happy. How? Probably transfer price, add marginal cost, other conversion cost, and add profit, final sale price. Marginal cost is 6, sale price is 20. Pretty sure. Now, under dual rate transfer pricing, fixing 15 is logically not advisable for B department. Said he is unhappy. Then the price fixed in this case may be making it a decent profit. Like so, I assume B department head makes a decent profit of 4 rupees per unit sold, assumed. Then what could be his total cost for manufacturing? 16, including the goods transfer from A department. The conversion cost is spent for the department B is 6 and transfer price should be only 10. Only 10. So B demands that you transfer it for 10. A says, no sir, I can sell it for 15. You calculate the incentive based on the 15 rupees only. If you ask me to sell to B, then my profit share will reduce and you will fix lower incentive. I don't accept. B says, if you don't fix the transfer price at 10, which is much lower than the market price, I'm still aware about that. But if it is not so, our department will always make loss. So otherwise you can simply wind up. So he is totally frustrated and unhappy. As per the dual rate transfer pricing, now what happens, A department transfers the goods to B, and for the transfer, A gets how much? 15 rupees as he expects. And how much B has to pay? B has to pay as per his expectation being around 10. In between that, common owner is there, probably managing director, common head. Give me 10 and my part 5 rupees is added, so A division will get 15 rupees. This is called dual rate, two rates. Subsidized like asking B to pay only 10 rupees. A wants 15 rupees. Never bother. Give me 10, I will add 4 and take 15 rupees to A. What is the ultimate results for the organization? Of course, organization results the same. Is that okay? Here, 5 rupees loss is there and A makes profit for rupees 4. Ultimately, 1 rupee being loss only. Earlier also the same happened. Division B says that I made a good profit of 4, but entire organization MD says 4 rupees we lost because of this dual rate tariff. This 5 rupees loss is adjusted here, ultimate result being what? The ultimate organization's profit and loss remains unaltered because of dual rate. Then why do I want to insist the dual rates are? So that B department also functioning in a decent manner. That's the logic here. Dual rate. Fixing the market price for A, fixing the marginal cost for B like. Okay, what is the marginal cost here, sir? Only 10, no? You assume this is being 10. So marginal price for market price for A and marginal cost for B. Difference is subsidized by common head. Because of that, the division A is also happy, division B is also happy. But sometimes later, both the division will support for the organization's growth, right? Now, in another case, two-part transfer price. Two-part is nothing but transfer price is nothing but marginal cost and fix a fee with that constant fee, annual fee like. Then transfer price in this case being 10 rupees. So here what happens? Division A transfers to B. Division A transfers to B, and then the transfer price is only 10. What is the profit for A? No profit. His marginal cost also 10 and transfer price also 10, no profit. And for B, transfer price paid for the material being 10 and conversion cost he incurred in his department separately, other than this being another 16 rupees and sale price being 20, then he makes a profit of rupees 4. But indirectly what happens, B transfers a fee yearly once, probably 50,000 rupees or 1 lakh like. This is called two-part. Marginal cost is final. Yearly once a fee will be transferred between these departments, or common head will take care of that payment. Is that clear? So dual rate is nothing but for the transferring department, transferor, okay, market price is fixed. For the transferee, marginal cost is fixed. In case of two-part, constantly fix the marginal cost as the transfer price. And in order to motivate the transferor for his own extra commitment, offer him annual fee. This is called two-part transfer price. Clear? If it is clear, text me. We'll move on to the next illustration. Now we'll move on to the next one. Now, in this illustration, the transfer pricing is equal to marginal cost as well as profit lost due to such operations called marginal opportunity cost. That should also be added. SSA Limited operates with the two divisions A and B. SSA has two divisions A and B. A produces component utilized by division B in manufacturing the final product. The projected output and cost of the upcoming period are as follows. A can produce 50,000 units, variable cost and fixed cost given, and B also can produce the entire things. Fixed costs are distinct for each division. This is inevitable. If you want to run division A, you have to spend 1,50,000 as a fixed cost. If you run division B, you have to additionally spend 2 lakhs. Okay, distinct. By closing this business, you can avoid this fixed cost. Usually, fixed cost cannot be avoided in case of shutting down of any one of the units. You just assume that a 10 by 10 size roadside shop, small shop, has a printer as well as a mobile top-up charging or recharge business also. He says the printer business has no profit, so he wants to close. Because of closing the printer, he cannot reduce the rental expenses, right? The rent he is already paying for the 10 by 10 size. So by closing one of the divisions, the profit will not mean fixed cost cannot be controlled, but here it's not so. Both are totally different. Probably he may have one shop for mobile recharge, another shop for this printer. If he wants to shut down, then he closes the shop and hands over to the owner so he can reduce the rate. That will be the scenario here. You are asked with advising on the transfer price for division A's component given the following scenario. Division A can sell the component in a competitive market for 10 rupees per unit. He can sell it to outside for 10 rupees. A price at which division B can also purchase the component. So B also can purchase it from outside for the same 10 rupees. Right. In addition to the scenario 1, so in this case it's very simple, only 10 rupees is the transfer price. In this case the transfer price is only 10, no problem. Scenario 1. In addition to scenario 1, suppose division B currently procures the component from an external supplier at rupees 10, which there A reciprocal arrangement between the external supplier C. See what happens here. There is a C. Another customer. And B can purchase it from outside. And what happens here? There is a reciprocal arrangement. Who's he? C. From C we can purchase it for 10. With whom one more agreement is entered by B. What's that? As part of this agreement, every component purchased by division B, the external supplier buys one product from division C. We have one more division, C. Okay. C division. From here, this supplier will purchase. Because of that, 4 rupees profit will be earnable. You understand? Now, what is the price you need to fix? See, if I fix 10 rupees and if it is transferred from A to B, naturally this supplier will not purchase it from C. Automatically we will be losing this. Then what could be the real transfer price? The normal price at which it is saleable outside. Because of transferring rather than outside, if it is transferring from A to B, profit lost should be also added. So final transfer price being 14 rupees. This is the market price or actual price fixed by A for transferring as well as selling. If B purchases from A and naturally the supplier will not purchase from our another division C where we made a decent profit for, we are losing that profit, also considered as your cost called opportunity cost. And now the transfer price along with the opportunity cost should be 14 rupees. Should be 14 rupees. Is that clear? Now, so we have completed two part tariff and all. Sometimes we may have full cost plus opportunity cost. That model also we have discussed. Sometimes the price may be negotiated. When an external market does not exist and the market prices are not available, they will negotiate. Right. And market price is available. Let's see this scenario here. This question number 4. I am going to use RI and ROI. RI represents residual income. ROI represents return on investment. If I invest around 10 lakhs rupees, I expect 10% return. For the 10 lakhs, 1%, 10% being 1 lakh should be included with the cost. That's what about ROI. In case of RI, for my investment, okay, sorry. In case of ROI, sorry, I just missed. Now, capital employed being 10 lakhs. Capital employed being 10 lakhs. In case of ROI model, okay, your net profit after tax being say 2 lakhs. Then what about ROI? You earned 2 lakhs rupees net profit for your investment being 10 lakhs. Otherwise, return by investment, capital employed. PAT by ROI is equal to 20%. This is what about the ROI case. In case of RI, capital employed being 10%, 10 lakhs, company's cost of overall capital being 12%. Now apply the RI to decide whether this project is viable or not. Net profit after tax in this case being 2 lakhs. From this, you have to subtract the expected interest payment for your investment as per your borrowing cost or KO. Capital employed into KO. 10 lakhs into 12%, 1.2 lakhs you have to pay for your funding requirement. In addition to that, yet you have around 0.8 lakhs in your pocket. This is called residual income. whatever the PAT you have, in that PAT, for the investment, what could be the cost of company's overall capital? Based on that, you can subtract this estimated cost you want to recover from the no PAT. Finally, you get this is called residual income. Residual income. Is that okay? In case of ROI, return on investment, whatever the return you get, that return earned because of this capital employed of 10 lakhs, and tell me in percentage is called ROI. So income earned, no PAT, for your investment of 10 lakhs, then ROI, return on investment, being 20%. Is that clear? Now let's try to solve this question number 4. If it is clear, text me. Now, a company has two divisions, division M and division N. Division M and division N. Division M has budget of selling 2 lakhs numbers of particular component X to fetch a return of 20% on the average assets employed. Okay, so their capacity is 2 lakhs units, and their expected return being ROI is equal to 20%. It's not RI. Okay, return on investment expected. The following particulars of division M are as follows: fixed asset, overhead, fixed overhead, variable cost, average assets also be given here. So for the average asset, what's the total assets? 12 lakhs. How much profit you expected here? 20%. 2.4 lakhs expected. Okay. So fixed cost, variable cost being 1 rupee per unit, estimated sales being 2 lakhs unit. For 2 lakhs units, what could be the variable cost? 2 lakhs. And your fixed cost being 5 lakhs. Expected return on investment 2 lakhs 40. Division M now expects 9 lakhs 40,000 rupees to be earnable for 2 lakhs unit. Then 4 rupees 70 paise is the selling price per unit. That's what about their expectation. Clear? So division M has budget of selling 2 lakhs number of particular component X to fetch a return of 20%. By selling 2000 units, their expected return also be 20%. Fixed cost given, variable cost given, assets given, on that expected return being 20% also given. So we calculated all the requirement, decided profit and cost put together 9 lakhs 40,000. We plan to recover by selling 2 lakhs units. It means 4 rupees 70 paise. However, there is a constraint in marketing, and only 1,50,000 units of component X can be directly sold to the market. Now, though they can manufacture how many units? 2 lakhs, but they can sell currently only 1,50,000. Balance 50,000 now remains unsold. What can we do? What can we do? That's a question. It has been gathered that the balance 50,000 units of component X can take up by division N. Okay, N is happy. Give me this 50,000 units, sir, I will take up. This 1,50,000 units, sold at the pre-budgeted price of rupees 4.7. The 50,000 units transferable by M to N. M is pretty happy to fix that the same 4 rupees 70 paise being the market rate, and N knows if N is not taking up, then definitely M cannot sell. So N also means demand for reducing the price within the same organization. Right. 50,000 units of component X can be taken up division N. Division M wants the price rupees 4. So division M expects 4 rupees. But division N is prepared to pay only 2 rupees. So this is the demand and this is the expected payment by N. Division M has another option in hand, which is to produce only 1,50,000 units of component X. What M can do? Produce and sell 1,50,000 units to outside and negotiate for a reduced price to be sold, transferred between M and N at either 4 rupees or as per the requirement of N 2 rupees. Of course, M demands 4 rupees, N is not accepting, it demands only 2 rupees. And M either accept for 50,000 units to be produced and transferred at a much discounted price expected by N, that means 2 rupees, or simply M can transfer to, means sell to outside at 4 rupees 70 paise to the extent it is saleable, 1,50,000 only. It cuts down the 50,000 units to be produced. This will reduce the holding of assets by 2 lakhs. By reducing the number of units produced from 2 lakhs to 1,50,000, the fixed cost means the asset value may be reduced by 2 lakhs. Earlier 12 lakhs, now the investment is only 2 lakhs, sorry 10 lakhs. 2 lakhs can be released. And fixed overhead by 25,000. That fixed overhead also be reduced by 25,000. You are required to advise the most suitable course of action for division M. Now you can use the RI method or ROI method, both the methods to solve. Both the options are good to use. What are the options? Produce and sell 1,50,000 units only. Number one. In that case, as per RI, what is the profit? As per ROI, what is the profit? And again, I'll fix the sale price at rupees 2 and decide whether it is advisable or not under RI as well as ROI model. Clear? So option 1. Option 1. What is that? Produce and sell only 1,50,000 units. At what rate? 4.7. What is the revenue you are getting? What is the option 2? Produce and sell another balance capacity can be transferred 0.5 lakhs units at the desired value of N. What is the desired value of N? He is willing to give only 2 rupees, 1 lakh. So if he produces and sells only 1,50,000 to the outside and never commits to supply to the other division, naturally what happens? His total revenue is only 7,05,000. Or he can supply to outside and also accept for the lower rate for the other division to transfer 8,05,000. Now, variable cost. Variable cost at the rate of rupees 1. In this case, 2 lakhs units are produced and sold. In this case, 1.5 lakhs produced and sold. Sorry, here 1.5 lakhs. And here 2 lakhs. Variable cost being 1 rupee. So, variable cost in this case being 1,50,000. In this case, we produce and sell and transfer 2 lakhs. No, so the variable cost is 2 lakhs. Okay. What about the fixed cost? You can subtract the variable cost from the sales to get the contribution. 6 lakhs 5,000. 6 lakhs 5,000. 5,55,000. Here 6 lakhs 5,000. And subtract the fixed cost. Fixed cost being 5 lakhs in this option. If you stop producing the additional 50, your fixed cost reduces by 20,000. So 4,80,000 only. And you will get earnings after tax. 75,000. Fixed cost on 4,75,000. Okay, sorry. 25,000 reduced, right? So EAT being 80,000 rupees, here EAT being 1,05,000. Now, if you see the EAT absolute term, option 2 is profitable, right? Absolute term. Option 1 gives you only 80,000 rupees gain. Then you can decide the option 2 is better. But anyhow, we never compare this one directly. We have to apply the RA or RY. Let's go for the what? RA case. In RA case, first of all, I have to subtract capital employed into cost of capital. What is the cost of capital here? We have 20%. 20%. If I calculate 20% on capital employed earlier, for 12 lakhs, 20%, 2 lakhs 40,000 you expected. Under this case, so here 2 lakhs 40,000, sorry. Under this case, your investment value reduces from 12 to 10 lakhs on the 20%, 2 lakhs. Now your residual income in this case being, subtract this from EAT, 1,20,000 loss, and here 1,35,000 loss. Definitely what happens, you should not recommend the option 2. Now what happens if we follow ROI approach? Under ROI approach, EAT is divided by capital employed to find out the ROI. ROI is equal to EAT by capital employed. EAT is 80,000. Capital employed in option 1 being 10 lakhs only. For 10 lakhs, 80,000 means 8% is your return on investment. And in option 2, 1,05,000 is the return, but your investment being 12 lakhs. As you are operating at full capacity, your requirement for the asset is 12 lakhs. If you are reducing your operations, then fixed cost reduces to 10 lakhs. Now here this value being 8.75. So from this what? From this ROI angle, division M makes nice profit. Earlier it's only 8%. By fixing even 2 rupees, it's decent. There is a decent increase in ROI. As per the company's expectation, 20% on asset employed is not possible, but at least you can rise from 8 to 8.75, even though the fixing price is very, very lesser. The transfer price is very, very lesser, 2 rupees, because variable cost is 1. By fixing 2 rupees, definitely incremental profit being 1 rupee there is, right? Hope you will be now able to understand. In Singar Academy text, I have used the ROI model to decide whether option 1 is better or option 2 is better. Clear? Hope you will be now able to understand the logic here. Transfer pricing fixation and general guidelines. SSA Limited produces and markets TV sets with the assembly division AD. Okay. Responsible for assembly. Picture tubes for the TV sets are procured from the picture tube divisions. Picture tube division, assembly division. These are the 2 divisions we have for SSA Limited. For SSA Limited. Is that okay? Which is currently operating full capacity. Already picture tube division is operating at full capacity. The incremental cost of manufacturing each picture tube is rupees 700. Incremental cost. Okay. Incremental cost to manufacture every picture tube being rupees 700 per unit. PTD has the options to sell the picture tubes in the open market at rupees 1100 rupees. They can sell it to outside for 1100 rupees. Incurring additional variable and selling and distribution cost being 40. So for that they have to spend another 40 rupees. Okay. So naturally PTD will get how much? 9,060. So 1,060 rupees net revenue. Okay. Alternately, if AD apps to purchase the picture tubes externally, if the AD wants to purchase it from outside, it will face variable purchasing cost rupees 20 per screen. Assume that 1100 rupees is the normal values traded in the market. PTD can sell it for 1100 outside. Similarly, AD also can purchase it from outside for 1100. But the trouble is, if the PTD wants to sell to outside, within the same factory, transferring from one division to other division has no expenses. Here there's a carriage outward like so around 40. Net realizable value PTD gets here being only 1060. Similarly for AD, though he can purchase it for 1100 to get it delivered to his place, he has to incur additionally another 20 rupees. So for him, 1120 is the purchase cost. This is purchase cost. For him, this is the net realizable value or net sale value. Determine transfer price range using the general TP guidelines. Come on, tell me. What could be the general TP guidelines to fix the range? You can logically think and tell me the answer. PTD will be happy to get even single penny more than the NRV. Is that okay? So currently, if he sells to outside for 1100, he has to incur around 40 rupees expenses. So only 1160 is possible net realizable value PTD will get. So PTD will be happy to get even 1 rupee extra than 1060. This is what about the PTD's expectation. What about the AD? AD can purchase it from outside. For that 1120 is payable. Apart from that, delivery charges another 20 is there. So there is no possibilities to get it for less than 1120. So he will be happy to get it less than this. So definitely the range should be anywhere between these two. If the price is fixed at 1100, PTD is also happy because he gets 40 rupees excess. AD is also happy because he gets 20 rupees cheap. Both will be happy, are absolutely making a 30 rupees profit. The price being 1090. Okay, this is the range. This is called general guidelines range. Clear? Hope will be now able to understand. What is the maximum price payable by AD if it is purchased from outside by including all the costs to get it delivered to its place? For PTD, what could be the net realizable value if it is sold outside organization? Is that okay? Shall I move on to the next one? It's pretty simple. I am discussing more, but nothing is there to copy. Another illustration is also TP general guidelines. TP general guidelines. SSA Limited operates with two profit centers A and B, where A supplies all its production to B. A to B currently. Variable cost from A amounts to rupees 410 and with fixed cost rupees 2000 per month. This is per unit. B incurs additional processing cost rupees 5 per unit for variable expenses apart from the amount paid for the raw materials transfer, along with the fixed cost rupees 1000 per month. The anticipated production volume is set at 500 units monthly. So production volume being 500 units per month. And the selling price for B's output is 25. B can sell it to outside at rupees 25 per unit. Determine the transfer price range using TP guidelines. TP, transfer price guidelines. Is that okay? Now, A says, forget about fixed cost, at least I need to get 10 rupees. Even if I fix more than 10 rupees, 1 paise, I am happy. My incremental cost is recovered. In case of B, what happens? In case of B, 25 is the sale price and his additional cost being 5. So 20 is the maximum possible amount B can offer to A for every units transferred. Maximum or less than that, maybe 19.9. This will be the minimum price A may demand. This may be the maximum price B can offer. Okay, otherwise 10 and 20. And by fixing the price range, transfer price anywhere between 10 to 20 will be mutually beneficial to A and B. Is that clear? So transfer price general guidelines. So we have completed all these things. Method of transfer pricing, RI and ROI model also completed. Conflicts between divisions and a company as a whole. When divisional managers have complete autonomy, divisional managers, in this case, right? In this case, what happens? A has complete autonomy. He will not obey what the management says. You have given me autonomy to prove good division, like by increasing your profit. My fixing price being only 15. B says, no, sir, I cannot follow. So there is a tug of war. Problem is there. Goal congruence gets affected. In that case, management will come for the rescue. Common management. Then dual rate and two-part theories are implemented. That's what about the case here. When divisional managers have the complete autonomy, they may prioritize their divisional goal, not the company's goal. Okay, potentially conflicting with the company's overall interest. In response, management may impose transfer prices to align with the broader company objectives. Now, the management's role is to fix the price. While fixing, they have a dual rate transfer pricing as well as two-part transfer pricing. Already we have seen. Clear? In case of some trouble, we may now understand the cross-train also for optimum utilization of labor for multiple divisions. For example, in an organization, division A and division B is there. Division A and division B is there. Here we have 10 employees. Here also we have 10 employees. Suddenly, the demand for this unit produced by B is increasing and here it is decreasing. Now, we have to recruit additional 5 employees here. As the production is decreasing, we have to terminate 5 employees. But recruiting and terminating will be really costly for the organization. What we can then do? Out of that, 5 employees are picked up. 2 from here, 3 from here. And these 5 employees are capable of manufacturing the item of A as well as B parallelly. So whenever B needs more employee, now you transfer from here and add here, transferring the employees. Thereafter, you have 5 employees and here 15 employees. The number of employees in the organization remains the same. You are not terminating or recruiting. Such a way the employees are trying to work both. That's called cross-train. Optimum utilization of labor for multiple divisions. Now these laborers are employable for division A as well as division B, cross-train. So international transfer pricing is nothing but transferring from one country to the other country within the same organization, right? Now some theory is also there. You can read it easily. Factors influencing international transfer pricing decisions. See, logically, I'll now touch upon the tax rates for international transactions. Small point. For example, organization A functions in India as well as A functions in any other Gulf countries. Tax rate in India is roughly 30%. But some of the Gulf country where the tax rate is nil. A can purchase for 100 by adding the profit 100, sale price being 200. Because of this, A has to what? Pay the tax on the profit rupees 30. Instead of that, no. A purchases and produces for 100, sells it to A Gulf country for what? The same 100 rupees. Sale price also 100. Now, what is the profit for A? 0. But A in Gulf countries sells it for 200 rupees. So, A India sells to A Gulf for the cost manufactured. So, profit and loss in this case being 0. But for A Gulf, the profit being 100. What about the tax, sir? In India, for the profit, 30% tax, 0 only. For Gulf, we don't have any tax, so 0. Ultimate results being 0 and 100. Overall organization return being 100. But in this case, 30 rupees has gone. The net post-tax gain they have is only 70. Such a way they can now transfer their profit to the some other countries. By transferring the profit earned in India to be earned in other country, like where the tax rate is 0 or lesser, tax haven countries, like it is stated, tax haven countries, okay, not tax hell. Huh? So that's a tax haven country where you can enjoy paying lesser tax or no tax to save more revenue in your pocket. But automatically, what happens now? In this case, if you are cheating, no, Indian government comes for one more tax levy. Whether this transfer price is genuine, then automatically what happens? If it is not genuine, then Indian government will fix this as 200 and calculates this additional revenue as your profit, and you have to pay the tax in India under section 92 and all, right? You will study that in your final. So the factor influencing the international transfer pricing, tax rates, duties, tariff, and income derived from derived and repatriation restrictions. You may derive the income in foreign country. Later on, to transfer from foreign country to Indian country will be a trouble. That's called repatriation problem. Repatriation problem. And fluctuation of foreign, all the things are there. So I have given one small example how this transfer pricing are influenced in case of international transaction. And what are the main objectives of transfer pricing? Minimization of import duty, direct taxation, repatriation to win host country approval, and all these things are small examples. Anyway, we have seen all the illustrations, transfer pricing methods, dual rate and two-part transfer pricing, marginal cost by adding small opportunity cost, RI model, ROI model, and transfer pricing general guidelines. What could be the normal price could be fixed for transfer the commodity from between the departments, so that it will not be having any trouble between these two departments also calculated. So finally, we'll go for the question number 7, the last illustration. Thereafter, some practical advanced illustrations also added here, around 4 illustrations apart from this. Okay. So concepts are over with this. After that, 3 more illustrations are there based on the exam questions. By solving all these things, the transfer pricing chapter is completely over. Clear? Theory is also over. Come on, tell me. Is it clear? If it is clear, text me. We'll move on to solving this illustration and subsequently 3 more additional illustrations. Transfer price with opportunity cost. Division A is a profit center which produces 4 products PQ and R, PQ, R and S. Each product is sold in the external market also. Data for the period is as follows. So these products are sold in the external market, available in the market. Okay. Market price and variable cost of production, labor order requirement is also given here. Product S can be transferred to division B, but the maximum quantity that might be required for transfer is 2000 units. Okay. This can be transferred. maximum 2000 units can be sold. So we have division A and division B. Division B manufactures 4 products and sells this to outside P, Q, R, S. But S alone can be transferred to division B also. But maximum 2000 units can be manufactured and sold to or transferred to B. Okay. Now, the maximum sales in the external market, external market, 3000 units, 3500 units, 2800 units, 1800 units. Division B can purchase the same product at a slightly cheaper price at rupees 225 per unit. This division B can purchase it from the outside at rupees 225. Actually 230 no market price, but B can demand for 225 itself to be purchased from outside. So if I fix market rate is 230 only, no, I'll fix the same 230 rupees. Purchase it for 230. Immediately B says, no sir, I can negotiate and can purchase for 225 itself. So from this it is very clear, S can fix the price less than 225. Okay. Now this is the main question for me. Apart from that, what should be the transfer price for each unit for 2000 units of S? If the total labor hours available in division A are, this is what about the labor hour available. So this illustration, one of the beautiful illustration. Why? Because in this illustration, marginal cost limiting factor problem is also included. Limiting factor problem is also included. So as per the limiting factor, come on, tell me. What about the contribution, sir? What about the contribution? Contribution per unit. You have to subtract the variable cost from the market price. 20 rupees here. And 35, 100, 45. Now come on, tell me. Contribution per limiting factor. For 3 labor hours, 20 rupees is earned. So you have to finish up this one only after listening marginal costing lecture. So marginal costing is the base for the transfer pricing, relevant costing, incremental costing, for all these things, right? In final, you have a separate chapter for relevant costing and transfer pricing in more detailed manner. For all these things, of course, marginal costing is the base. So here contribution per limiting factor for 3 hours of labor, we get 20 rupees or per unit 6.67. And here 8.75. Here 50 rupees. Here 15 rupees. Now rank for manufacturing. First rank, second rank, third rank and fourth rank. Right. Now we have 24,000 hours only. Come on. Find out the production here. Hours available 24,000 units hours. First use it for producing R. How many units can be produced? The maximum demand is 2,800 only. Producing more than that, you cannot sell in the market. Use the labor hours completely for producing the maximum requirement of R. The time required being 2 hours per unit, so 5,600. After this, your available time decreases to 18,400. Second rank goes to where? Yes. How many units can be manufactured and sold? 1800. Time requirement for this being 3 hours, so multiply with the 3. 5,400. Ultimately, how many hours you have? 13,000. Then Third rank goes to Q. How many units can be saleable? 3,500 into 4. 14,000 we don't have. So entire 13,000 can be used for producing Q only. For Q, we need 4 hours. Then how many units can be manufactured? 3,250 only. Clear? Clear? Come on. Tell me. What about the transfer price, sir? Transfer price of S. Marginal cost for manufacturing S being 185. Apart from that, already we have shortage of hours, isn't it? To supply their requirement, how many units? How many units are in need? 2,000 units. To supply the 2,000 units, we have to stop producing some other profitable product. Which product you will stop? The product which gives you lesser revenue will stop. Which gives lesser revenue? Q. So you have to stop Q. As you are stopping production of Q to make the hours available for producing S, you are losing the profit from Q. No, that is called opportunity should be addable. How much is that? I need how many hours? 2,000 units per hour required 3. Per unit requires 3 hours. Okay, 3 hours. 6,000 hours required. So currently we are using 13,000 hours for Q. So I am now borrowing 6,000 hours from Q. Ultimately you are losing the gain of Q. How much is that? 8.75. What is the value you are getting? Otherwise, per unit basis means you can cut the 3,000, 2,000. So 3 into 8.75. 26.25. Okay, divided by 2,000. So your transfer price in this case being 211.25. 211.25. Next scenario, if the available hour is 32,200, same way hereafter you can repeat it. You can repeat it. Yes. Now for 32,200, second option, hours available being 32,200, produce R 2,800 units, consumed 2 hours, so 5,600, balance being 26,600, and then you can produce S to the maximum extent 1,800 into 3 hours, 5,400, then 21,200, then you can produce third option 3,500 units can be produced for every unit, 4 hours required. So 14,000, we have sufficient time. 21,200 divided minus 14, 7,200. Of course, you can go for manufacturing P also. What is the time requirement? 3,000 into 3, 9,000. We don't have 9,000. So entire 7,200 can be used for this. Okay. How many units can be manufactured? 2,400. Now find out the transfer pricing here. Transfer pricing of S in this case equal to marginal cost being 185 plus opportunity cost. Okay, what is the opportunity cost? Now I have to stop producing P to get the time required. So I need 6,000 hours, right? I need 6,000 hours borrowed from P. Okay, 2,000 units supposed to produce into 3. 6,000 hours needed. For every hour, I was earning how much earlier? 6.67. I am losing that. This is the total opportunity cost, but for every unit divided by 2,000. Then what's the value? 20 directly. So 205 will be the transfer price. I request the third option to be solved by yourself, or I'll finish up fourth option first and I'll solve the third option. What's the total time requirement? Okay, 3,000 into 3, 9,000. 3,500 into 4, 14,000. 2,800 into 2, 5,600. 3 into 1,800, 5,400. Am I right? What's the total time requirement? Huh? 34,000. What is the time available for the fourth option? We have 6,000 surplus. Then we don't have the opportunity cost. Then transfer price in this case is equivalent to 185, the variable cost only. Opportunity cost being 0. The time remains idle. Whether you use it or not, it is going to be lost only. So you can use it. So let me try to solve the third one here. Third one you can solve the same way. I'll finish up that here. Hours available. $30,100. First to start with R 2,800 into 2, 5,600. What is the final value? 24,500. Yes. 1,800 into 3, 5,400. 1,900. And Q 3,500. Okay, into 4, 14,000. We have 5,100. But P, we can manufacture how many units? Only 5,100 can be used for P. I am in need of 3 hours, then 1,700. Now fix the transfer price here. Transfer price in this case is equal to marginal cost 185, opportunity cost. What is the opportunity cost here? I need to borrow how many hours? 6,000 hours. 5,000 hours I can borrow from P. If I borrow from P, the profit of P is lost, which is 6.67. Apart from that, another 900 hours required can be borrowed from stopping the production Q. For Q, every hour it fetches me 8.75. This is what about the total amount I am losing. This amount lost will be now divided by supply to the other department. Yes, come on, tell me the value. 20.94. So here the value being 205.94 is the transfer price. Is that clear? This particular number is unique because you are stopping the production of P completely and production of Q partially. The revenue lost because of stopping the production of P and partially stopping the production of Q will be divided by the all the units is supposed to produce by S, produce C. Yes. So that will be the opportunity cost can be addable here. Text me once it is clear. Yeah. So we have almost completed all the illustrations related to the transfer pricing. Some variants now going to be discussed here. Mrs. Bright Star has two divisions, Bright and Star. Bright manufactures an intermediate product for which there is no intermediate external market. Star incorporates this intermediate product in the production of the final product. Bright selling to the outside, not possible as there is no market. The expected units of the final products which Star division estimate it can sell at various selling prices. Now Star can sell based on the selling price fixed. If the selling price fixed by Star being 1000, 10,000 units can be sellable. If the price is reduced by 100, the quantity sold is simply doubled. Is that okay? Simply doubled. Now, so we have been given variable cost and fixed cost and all. I'll just put the values here. Now, this is what about the variable cost and fixed cost. Now, the transfer price is 350 for the intermediate product and is determined on full cost plus basis. Okay, full cost plus basis. You are required to prepare profit statements for each divisions and company as a whole for the various selling price. State which selling price maximizes the profits for the Bright division and the company as a whole. So from here to here, while transferring the selling price being transfer price being 350. Right. So now we have to find out what selling price is going to be fixed by Star, so that divisional's profit will be higher as well as company's total profit is also higher. So in all the angle you have to tell. If you fix the selling price being 1000, transfer pricing no doubt it's 350. Is that clear? Come on, tell me. For Bright, what is the profit? Bright. How do you calculate for Bright? Okay, sale price or transfer price minus for Bright, transfer price minus variable cost into quantity transferred minus fixed cost. Am I right? Same formula, marginal costing formula. Transfer price is 350, variable cost 110, quantity transferred being 10,000 units, and fixed cost in this case being 60 lakhs. Yes, come on, tell me. What is the profit for Bright here? 36 lakhs loss. Similarly, only 900 units means 900 means 240 into 10,000 minus 60, 20,000 units, right? So 20,000 units 240 minus 110 into 20,000 units minus 60 lakhs. Tell me, 12 lakhs loss. If 30,000 units, selling price is 800. The transfer price is the same, 350. So by increasing every 10,000 units, your loss decreases by 24,000 or profit increases by 24,000. Only what? This variable cost, 350 minus 110 is the contribution for every 10,000 units, 24 lakhs is increasing. So then it is 12 lakhs gain, 36 lakhs gain, and 40. Here 50,000, another 24 is added, so 60 lakhs gain, and in this case 84 lakhs gain. This is what about the profit of Bright. Bright makes nice profit by selling 60,000 units. If Star can sell 60,000 units, Bright can supply 60,000 units at the transfer price of 350, makes huge profit of 84 lakhs. But in case of Star, they have to adjust the price as per the number of units to be sold. If they fix the price as 1,000, the number of units saleable in the market is only 10,000. Now you have to find out the profit for Star. Okay, let's go for Star. For Star, transfer price, sale price minus transfer price paid minus variable cost into number of units minus fixed cost. For the first case, sale price is 1,000, you fixed at rupees 1,000, but the transfer price paid for getting the material from the Bright department being 350, and further process, this one is 1,000, right? Sale price is 1,000. So from the Bright, goods is transferred to Star at 350. Star spends conversion cost 70. So 350 plus 70, 420 will be the variable cost for every unit manufactured. The number of units saleable, if the price being 1,000 is 10,000, and fixed cost in this case being 90 lakhs. Yes. Come on, tell me the final price. 32 lakhs loss for Star. And if the selling price being 900, 900 minus 420 into 20,000 units minus 90 lakhs. Now the value being 6 lakhs gain. Similarly, if you calculate 24 lakhs gain, 22 lakhs gain, no profit, no loss, 42 lakhs loss. Now, as a whole, okay, Bright and Star clubbed, 36 plus 32, both are negative, so 68 lakhs loss. Here 12, this one is positive 6, so 6 lakhs negative. Here 36 lakhs, here 58 lakhs, 60 lakhs and 42 lakhs. Now choosing, Bright is happy to sell all the 60,000 units, but Star prefers to fix the selling price at 800. So Bright wants to sell 60,000 produced and sold to Star by fixing 350, but Star is happy to sell only 30,000 units by fixing 80,000 rupees because at that time their profit is higher. These are the individual divisions profit, but as per the goal congruence, company's profit is the most important. As per the company's view, this 60,000 will be the 60 lakhs is the best one. So we have to recommend to fix the selling price being 600, try to sell 50,000 units. That's the recommendation given to Star, and of course you can negotiate the transfer pricing accordingly. Then the management will come for the interferences. Okay, Don't allow the bright independently make the decision as well for star. Hope now will be able to understand this one. Clear? Text me. We'll move on to the next illustration. Now, Royal Industries Limited has two divisions M and N. Division M manufactures product A15 which it sells in outside market as well as to division N sells to outside as well as transferring here. What? A15. The product name is A15. The managing manager of division N has expressed the opinion that the transfer price is too high. The two divisional managers are about to enter into discussions to resolve the conflict. The manager of division M to supply him with some information prior to the discussion. Division M has been selling 50,000 units to outsider and 10,000 units to division N. So 50,000 units sold outside, 10,000 is transferred to N currently. All at rupees 25. At rupees 25. It is not anticipated that this demand will change. The market demand remains the same 50. We cannot expect increase and decrease of that. The variable cost being 15 rupees and fixed cost being 3 lakhs. Divisional investment in asset being 12 lakhs. Investment. Already similar illustration we have seen, right? The same illustration, RA and RY case. RA and RY case. The manager of division M anticipates that division N will want a transfer price of 22. So what he anticipates is N may demand to supply it at only 22 rupees. There should be reduction by 3 rupees. If he does not sell to division N, 40,000 fixed cost and 2 lakhs fixed assets can be avoided. So if he doesn't transfer to N, M to N is not done, then automatically fixed cost will reduce by 40, otherwise 2.6 lakhs. And fixed asset will also be reduced to 10 lakhs. That's how the change happens. The manager of division M would have no control over the proceeds from the sale of assets and is judged primarily on his rate of return. So you cannot sell the investment to reduce from 12 lakhs to 10 lakhs. Anyhow, it just based on some return on rate of return expectation requirement. Should the manager of division M transfers its product at 22 to division N, or not? What is the lowest price of the division M should accept? Right. First, you try to understand current scenario and then recalculate assuming 22 rupees and assume you stop transferring this. All the scenarios are going to be independently worked out. Right. Now, first scenario, what's that? Sell transfer. Okay, both are at rupees 25 each. 50,000 into 25,000. Yes, come on. 50,000 units and 10,000 units. 50,000 into 25, 12 lakhs 50,000. 10 rupees into 10,000 units, 25 rupees. 10,000 units at rupees 25 each, 2.5 lakhs. Overall collection being 15 lakhs. Variable cost being 15 rupees per unit for 60,000 unit. For 60,000 unit, right? 50 plus 10, 50, 60. 60,000 into 15 rupees, 9 lakhs. And fixed cost is also there, 3 lakhs. Now you subtract these two, then you will get profit. Profit being 3 lakhs. Find out ROI. How do you calculate the ROI? Profit by capital employed in percentage. Capital employed being 12 lakhs. For 12 lakhs, 3 lakhs is earned 25%. 25% is the ROI currently. You know that this is not possible. This is not definitely possible. What the division M can do? Either accept for 22 and do the operations, or simply stop and go for external sales only. So we'll see the option 1. Option 1, we accept to transfer at 22 rupees, 25 and 22. Option 2, 25 and no transfer at all. These are the two options. Come on, find out the answer. Sale to external market 12 lakhs 50. Transfer, yes, did, but at discounted price 22 into 10, 2 lakhs 20,000 rupees. Naturally, your overall revenue reduces by 30, so 14 lakhs 70. And your variable cost in this case being 9 lakhs because you produce all the units 60,000. Fixed cost also being 3 lakhs and 12 lakhs can be subtracted from here, 2 lakhs 70. Now, what about the ROI here? 270 is your return for your investment of 12 lakhs. So naturally, 22.5%. Your ROI decreases from 25% to 22.5. You can then go for only selling to outside, not transfer. If you go for that option, what happens here? Selling to outside, you will get 12 lakhs 50. No transfer, so your overall revenue is 12 lakhs 50. Variable cost being 15 rupees, but you are producing only 50,000 units for sale. 15 rupees into 50,000, 7 lakhs 50,000. And fixed cost, if you are not operating, reduces by how much? 40,000 rupees. Now it is only 2 lakhs 60. So now you have to subtract these two costs from 12 lakhs 50. Your total profit being 2 lakhs 40,000 rupees. Now tell me your ROI. 240 is for your investment 10 lakhs. 24% is your return. 24%. Now, if the management decides the performance of the divisional head based on ROI, definitely this option is better, not this option. Division M head says, if I don't supply to you, I can get 24% on my investment. Because of supplying you, my ROI decreases from 24 to 22.5. As per my previous expectation, 25 is my correct ROI, but because of this issue, I can stop supplying you, but I can still earn a decent ROI of 24. Only 1% loss is there. But if I accept for 22 rupees, my ROI decreases from 24 to 22.5. I am further losing. Definitely will not accept. For what? 22 rupees. If you demand for 22, I am not able to accept this. Then this question, what is the lowest price that division M should accept? Then what could be the lowest price? As he is not accepting for 22, what is the lowest price? So lowest price, very simple, he has to get the same 24%. The same 24% on his investment he has to get. To get the 24%, what happens here? For this 12 lakhs, come on, tell me. For the 12 lakhs, he has to get 24%. This is what about the expected return. Apart from that, total cost. How much is that? 12 lakhs. For how many units? This is what about the total cost. From the total cost, I am subtracting the sales value recovered from external sales, which is 12.5 lakhs. Balance is the amount expected for what? Expected for what? Internal sales, internal transfer. Internal transfer being how many units? 10,000 units. So divide by 10,000 to find out the revised sale price, revised transfer price. So my expectation being this one and my fixed cost. This is what about my total cost for producing completely for 60,000 units. By selling 50,000 units outside at the rate of rupees 50, out of this total cost, this revenue is received already. After that, balance to be recoverable from the transferee of 10,000 units. I divide with 10,000. So 23.8. If I fix the transfer price being 23.8, of course, existing 25 is reduced and 23.8 fixed. My ROI remains same, 24%. If I sell only to the external market, I will get decent 24%. The same 25%, 24% I expect to get that same 24%. I now fix the price being 23.8. Clear? If it is clear, text me. We'll move on to the last illustrations. Now, third question. Fasteners Limited is having production shops reckoned as cost centers. Each shop charges other shops for material supplied and services rendered. The shops are motivated through goal concurrence, autonomy, and management efforts. Foster Fastener Limited is having a welding shop and painting shop. So they have two shops, welding shop and painting shop. Right. The welding shop welds annually 7,500 purchased items with other 1,50,000 shop made parts into 12,000 assemblies. So how many units are manufactured? 12,000. For that 7,500 units are purchased. 1,50,000 small parts also manufactured. All these things are assembled and produced into 12,000 fully completed units. The assemblies are having total cost of 9 rupees 50 paise each and are sold in the market rupees 12. So here variable cost being 9 rupees 50 paise and sold in the market at rupees 12 rupees each. Out of the total production, 80% is diverted to painting shop. In that, 80% is transferred here. 80% means 9,600. Am I right? And 2,400 units are sold outside currently. The price ruling in the market. This also transferred at the same 12 rupees. Welding shop incurs a fixed cost of rupees 25,000 per annum. The painting shop is having fixed cost rupees 30,000. For the painting shop, the fixed cost being 30,000. And its cost of painting, including transfer price from welding shop, comes to rupees 20. Variable cost being 20. Means 12 rupees plus conversion cost 8. Okay, including the transfer price paid. The shop sells all the units transferred to it by welding shop at 25 per assembly. Finally, it is sold to outside at rupees 25 per assembly. You are required to find out the profit of individual cost centers and overall profitability of the concern. Current scenario. Okay. Recommended course of action is the painting shop wishes to purchase at full requirement at market price, which is 10 per assembly, either from open market or from welding shop at the market price. So, painting department has the option to purchase it for 10 rupees from outside and demands the same price is offered to WS also as a transfer price. Give reasons for your recommendation. Now what happens, can we recommend to transfer, fix the transfer price to be 10 rupees, reduced from 12 to 10 rupees. Okay, that's the scenario. Let's see. Now, we'll start with the first scenario. Existing scenario. What is the existing scenario? Transfer price or sale price for welding shop, for painting shop. What is the sale price and transfer price? Sale price also 12 rupees, transfer price also 12 rupees, but sold to outside only 2,400 units, but transfer being 9,600. This is the current scenario. Come on, tell me, what is the sales revenue? 28,800, 1 lakh, 15,200, overall revenue being 1,44,000. Now minus variable cost. What is the variable cost here? 9 rupees 50 paise. How many units are manufactured and transferred? 12,000. So 12,000 into 9.5, 1,14,000. And if I subtract, then I will get the contribution being 30,000. What is the fixed cost? 25,000. For WS, it is 25,000. Then profit in this case being 5,000. For PS, sale price being 25. Okay. How many units are sold? 9,600 units. 9,625, 2 lakhs 40. And what about the variable cost? Variable cost is 12 plus 8. Transfer price plus variable cost. So 12 rupees plus 8 rupees, 20 rupees. Okay, 20 rupees into 9,600, 2 lakhs, 1,92,000. Okay, 9,600 units. This one is 25. This one is 20 rupees. 1,92,000. Now, contribution 48,000, fixed cost being 30,000, 18,000. What is the company's overall profit? Company's overall profit being 23,000. Clear? Now, in the second option, the transfer price is going to be negotiated. PS demands only 10 rupees, but WS says no. Then what happens in this case? WS simply manufacture and sell only 9,600 units. Okay, and asking him, painting shop, to purchase it from outside. That will be the one option. The another option, no other, he will sacrifice and sell it at 10 rupees. Right. So now what is the option I am going to guide you here? Sale price being 12, and transfer price being 10 as per the request from the PS department. Come on, tell me. Sale price at rupees 12, transfer price at rupees 10, units being 2,400, 9,600, and for WS department, sales being 28,800, transfer price being 96,000. 1,24,800, and variable cost being 9.5 for 12,000 units. The value being 1,14,000. There is no any change, that remains the same. 10,800, and you have to subtract the fixed cost being 25,000. Because of accepting this one, they will face a loss 14,200. In case of painting shop, okay, how many units are going to be purchased and sold here? 9,600. The transfer price being, sale price being 25, so 25 into 9,600, 2 lakhs 40. But the variable cost in this case being, this 12 is reduced to 10, no. So 10 plus 8. Earlier transfer price 12, now they fixed the transfer price being only 10, so 12 is reduced to 10, so 10 plus their conversion cost 8, 18 rupees will be the new value. Find out The variable cost at the rate of 18 for 9,600, 1,72,800. Then your contribution 67,200, fixed cost being 30 is subtracted, and ultimate profit being 37,200. So this plan is really suitable for PS. They are very happy, but WS is unhappy because they are losing the money. So immediately W says, okay, now I'll go for stopping supplying you, only sale at rupees 12. Transfer price is not accepted. In this case, sale 2,400 units only can be saleable in the market. At the rate of 12, 28,800 you are getting. And from there you have to subtract the variable cost. Variable cost being 9 rupees 50 paise for 2,400 units into 9.5. What's the value you are getting? 22,800. So your contribution being 6,000 contribution. From there you have to subtract fixed cost, which is 25,000. So 19,000 being the loss. Okay. What about the scenario of PS? That remains 37,200. Anyhow, whether WS supplies at 10 or not, he will purchase it from outside at the same 10 rupees. No, for them the profit is same. So whether he supplies it at 10 rupees or doesn't supply will not make any difference for the PS department. They can pay 10 rupees and get it transferred from WS sales. They will pay 10 rupees and get it from outside. Their ultimate profit is the same. But WS now gets affected. Accepting 10 rupees transfer price, their loss is lesser, otherwise loss is higher. So now you try to find out the whole organization's profit and loss. 37,200 minus 14,200. 23,000 is the organization's profit. But if the transfer price is not accepted, what is the result? 18,200. Overall organization's profit is decreasing. Goal congruence gets affected. So because of the autonomy of the department head, PS unilaterally decides that without consultancy with the WS, so I won't purchase from you. And he shares that I made a nice profit of 37,200, but it affects the overall organization's interest. So overall organization interest is affected. No, so organization head will come and score out this one and compels PS to purchase at 12 rupees or 11 rupees or negotiated price or dual price, whatever price may be, fixed to resolve their conflict. The thing may be happening here. So earlier 23, the same 23 is reflecting here. But if the transfer is completely stopped, the profit for the entire organization gets affected. Anyhow, PS is happy. But organization overall revenue should not be affected. So that's the reason this is not recommended. So you have to go for fixing the transfer price being 10, though WS making loss. Is that clear? Hope now you'll be able to understand. So with that, all the concepts of transfer pricing and related illustrations are over.